The first thing I want you to know is that when you see an interest rate related to a mortgage, you're seeing that number as a yearly figure, but you're actually making interest payments on a monthly basis for whatever amount is left of your loan. So in this example here, we're still using the figures from the previous slide, the $109,900. We're going to assume that this loan is a 30-year fixed mortgage at 2.5%. So how are we going to calculate exactly how much interest you're going to be making on your first payment? Well, we're going to follow this formula right below it, where we're going to take that 2.5%, right, because it's a yearly figure, and we're going to divide that by 12 to get a monthly amount. And then we're going to multiply that percentage by our $109,900. And so for our first payment, this is the first payment right after you move in, the first payment to the lender, the total interest you're paying to them is $228.96. For your second payment, as you can see, the loan amount has changed because every payment that you make towards the lender, a portion of it goes to interest and a portion of it goes to the principal. So on your second payment, your second month in your new home, your total loan amount is now $109,694.71. So using the same criteria here, again, 30 years, fixed rate at 2.5%, we're going to do the same formula down below, which shows that we're going to take that 2.5%, that yearly figure for our mortgage, we're going to divide that by 12, and then we're going to multiply that by our current loan balance, or our remaining principal balance that we owe the lender. Once we do that, we actually see that our interest being paid on that monthly payment goes down to $228.53. So what this is showing is, between our first payment and our second payment, we're actually paying 43 cents less in interest because our loan balance has decreased.